Hello, everyone, and welcome back to the Deep Dive. We're diving deep into the infrastructure that powers global finance, and today we're dissecting one of the most remarkable and seemingly unassailable business models in the entire world. We are breaking down the CME Group. This company isn't just an exchange. It's the dominant global giant of financial derivatives, operating as the essential Tollbridge on virtually all major interest rate, commodity, and equity risk flows. CME collects these high-margin fees across massive, massive volumes of risk transfer. They look like a perfect investment, but the central question for us, for you, is this. Are investors currently blinded by the certainty of the moat? I mean, does the market ignore structural threats, either regulatory pressure or technological cracks, that could permanently impair its extraordinary 75% pricing power? Or is this fortress truly absolutely unassailable?
That is the essential tension of this business, and it is a massive question that we really need to unpack with surgical precision. Before we start tearing into the mechanics of that mode, just a quick note for everyone listening.
Yeah, for those who want to execute on deep analysis like this, I mean, whether that involves trading complex derivatives, utilizing options, or just buying cash equities, having a professional-grade platform that delivers stability and low costs is, well, it's non-negotiable. We rely on Interactive Brokers, and we've partnered with them to get our listeners a stock bonus when they open a new account.
That's right. So you get a nice initial bonus to start your portfolio, and you directly support the channel's ability to, continue doing this deep-level research. The link is conveniently located for you right down in the description.
And of course, if you appreciate this kind of in-depth, nuanced discussion, if you want to be well-informed rather than just spoon-fed headlines, the best way to signal that value and ensure you get notified for the next deep dive is to hit that subscribe button, like the video, and jump into the conversation in the comments below. Let us know what you think of CME's position.
Perfect. That sets the stage. Now let's get straight into the engine room. Pillar number 1, the enduring business and the competitive fortress. We need to define exactly what this Tollbridge is and, why it functions.
The beauty of CME Group, despite all the complexity of futures contracts, is really the simplicity and the intelligibility of its core revenue engine. It is infrastructure, pure and simple, but what exactly are the moving parts that generate that enormous cash flow?
You're right. It's almost elegant in its simplicity. CME Group operates the world's largest marketplace for standardized futures and options. They are, at their core, a utility for risk management. Their revenue streams are kind of dual-pronged. First, the vast majority comes from clearing and transaction fees from every single trade executed on their platform, which is CME Globex. And this volume is measured by a key metric, average daily volume, or ADV.
Okay, that's the main driver.
That's the main one. But the secondary stream, which is so crucial because it's almost pure profit, is market data. This involves selling the proprietary, quote, price and trade data that's generated on their exchanges.
So they create the data by running the market.
Exactly. They create it, and then they sell that necessary information right back to the high-frequency traders and the big institutions who, frankly, need it to execute their strategies.
That market data segment is so often overlooked. It's high margin, it's incredibly sticky, and it's essentially a passive income stream that's just derived from the core business. But ultimately, the core profit driver is just simple volume and pricing power, isn't it? ADV times the fee per contract.
Precisely. And this is where the clearinghouse becomes the key piece of the architecture. The CME clearinghouse is not merely some administrative function. It is the central counterparty for every single trade that occurs.
Explain that role for a moment, because this is what elevates them beyond just an electronic matching platform to a required essential utility.
Right. So when Party A agrees to buy a futures contract from Party B, they don't actually transact with each other. It's not peer-to-peer. They both transact with CME's clearinghouse.
So CME is in the middle of every trade.
In the middle of every single one. And the clearinghouse guarantees the performance of both sides of the contract. This completely eliminates what's called counterparty risk, the fear that the person on the other side of your trade might just default and not pay up.
Which is the biggest fear in finance.
It's the systemic risk everyone worries about. And to manage this huge risk exposure, the clearinghouse dictates and collects margin, which is just collateral, from both parties, and they do it daily. This margin ensures that should a party default, the clearinghouse has the funds on hand to make the non-defaulting party whole. That stability, that certainty of performance is what financial institutions pay dearly for. It's the very bedrock of the entire derivatives market.
So the business model is really rooted in these perpetual structural trends. We're not talking about a fad here. We're talking about the fundamental human need to hedge risk.
Absolutely. The endurance of this model is rooted in financial complexity. I mean, as long as central banks change interest rates, as long as wars affect oil prices, and as long as harvests are unpredictable, there will be volatility.
And someone has to manage that volatility.
Someone has to. Commercial entities must mitigate it. Farmers, airlines, huge pension funds, they use these contracts not for some exotic speculation, but as indispensable tools to transfer risk away from their core business. CME simply provides the standardized, regulated digital venue for that unavoidable need. And that's why this business model is, it's nearly eternal.
And that leads us directly to the fortress. We need to spend some significant time here mapping out this moat because simply calling it a network effect doesn't really do justice to the decades of regulatory and technological work that went into building it.
You're right. The CME's moat is a multi-layered masterpiece, really. It's built on network effects, standardization, and intangible assets, particularly regulatory approval and just trust. But the primary layer, without any question, is the liquidity network effect.
Unpack the mechanism of liquidity, because this is the active competitive weapon that repels any would-be competitors.
Okay, think about what a major institution needs when they manage risk. They might need to hedge, say, $10 billion worth of interest rate exposure. They need two things: absolute confidence that the trade will be guaranteed.
That's the clearinghouse.
That's the clearinghouse. And second, they need the tightest possible bid-ask spread. They need maximum liquidity.
To keep their own costs down.
Exactly. To keep execution costs from eating their lunch. And why does CME have the deepest liquidity? Because they own the contracts that have been established for decades as the global benchmarks, the gold standard. We're talking about SOFR futures, which defines interest rate risk management in the U.S. now, and U.S. Treasury futures, the main tool for hedging government debt. They also own the E-mini S&P 500 futures, which is the global standard for equity index risk.
So if you're a major bank or a huge asset manager, you must trade those contracts. You can't just go to some new upstart exchange, even if it offers lower fees, because the bid-ask spread would be, well, it'd be disastrously wide. Your execution costs would just skyrocket, eating up any fee savings immediately.
Exactly. The depth of liquidity creates this powerful virtuous cycle. More traders mean tighter spreads. Tighter spreads attract even more volume, and more volume reinforces the status of that contract as the benchmark. This loop generates massive volume, making CME the cheapest and the safest place to trade, which actively and very powerfully repels competitors.
The competitive barrier this creates is monumental. It's not just about money, is it? It's time and trust.
It is economically prohibitive for new entrants. I mean, imagine trying to replicate the SOFR futures market today. A new exchange would need to commit billions of dollars just to subsidize liquidity.
Paying people to trade, basically.
You're literally paying institutions to trade on your platform for potentially years, just to attract the critical mass you need to get competitive spreads. Most attempts fail before they even get off the ground because institutional traders will not compromise on liquidity or, just as importantly, trust. CME has an intangible asset in the form of decades of accumulated regulatory acceptance and operational integrity. You can't buy that overnight.
And crucially, this moat isn't static, right? It's assessed as stable to slowly widening. Where do we see the evidence of that widening happening right now?
We see it in two really high-growth adjacent markets. First, the move into micro-futures.
For the retail crowd?
Exactly. These are smaller contract sizes catering to the retail trading boom, and it extends the network effect to millions of new participants. The volume growth there has been robust. Second, and this is perhaps more strategic, is their early dominance in regulated crypto futures, specifically Bitcoin and Ether.
That's a huge one.
It is, because as regulators globally look for stability, and as institutional capital starts to flow into crypto, they inevitably turn to regulated established venues. CME's ability to offer a regulated, cleared product immediately gives them a massive advantage over all those unregulated offshore exchanges, extending their network effect into the most modern asset class.
And the technological layer of the moat is getting thicker, too. I'm thinking of that massive partnership they announced with Google Cloud.
That partnership is critical.
Yeah.
It's not just about, keeping the lights on. In the world of high-frequency trading, latency, the speed of data transfer, is currency.
Milliseconds matter.
Microseconds matter. And that 10-year migration to Google Cloud is designed to optimize latency for institutional traders all over the globe and to allow CME to accelerate product innovation at a much lower cost. It solidifies the technological aspect of the moat against any potential fintech disruption. They're using their massive scale to continuously update the infrastructure and raise the minimum bar for any potential competitor.
Let's connect this back to profitability using our investment mental models. This is the absolute definition of a Tollbridge business, right? Extracting a small percentage from an enormous, unavoidable flow.
Yes, and it also perfectly embodies Charlie Munger's concept of wretched excess profitability. Once they have built the exchange technology, the clearinghouse, and gotten all the regulatory approvals, the cost to maintain and operate that infrastructure is minimal compared to the revenue it generates.
They don't have factories or ships or inventory.
Nothing like that. Their maintenance capex is tiny.
And what does that mean for the margin structure? I mean, those numbers are just eye-popping.
It means you get those extraordinary figures we mentioned at the top.
Yeah.
Pre-tax profit margins consistently holding in the 75 to 76.5% range. To put that in perspective, compare that to even the best software companies or, traditional utilities. This is rare air. It's the defining financial trait of a capital-light, dominant infrastructure play. And the result is exceptional free cash flow generation. A river of cash just pouring out of the business with very few places for it to stop.
That structural advantage is what justifies the premium valuation, but we can't ignore the competitors who are also, world-class institutions. How do CME's major rivals actually stack up?
We have to assess the competitive landscape carefully because they all operate in adjacent or specialized niches. They aren't all fighting for the exact same dollar. The primary competitor is the Intercontinental Exchange, or ICE. ICE is very strong in energy futures, particularly the global benchmark, Brent crude, and it has a much broader, deep portfolio of market data and technology services focused on over-the-counter, or OTC, and cash markets.
But where does the competition fall short when you put it up against CME?
Well, ICE just doesn't have the durable, high-volume dominance in the core financial futures, the interest rates, and the equity indexes that CME commands. ICE's strength in data services is where the competition is most direct. They are actively competing against CME's high market data revenue stream. But when it comes to that vast ocean of financial risk hedging, CME remains supreme.
Okay, then you have CBOE Global Markets, or CBO. They feel like a different animal altogether.
They are. CBOE has specialized dominance in volatility products like the famous VIX index and in equity options. They're incredibly successful in their niche.
But it is a niche.
It's still specialized, yes. CME's strength is its comprehensive breadth across 6 major asset classes: rates, equities, FX, energy, agriculture, and metals. For a global macro investor or a bank managing a whole portfolio of diverse risk, CME is the essential one-stop shop. They capture the entire economic cycle of risk.
And let's address the new aggressive entrants like FMX, backed by some serious financial capital, which are trying to attack CME's core Treasury futures market. They're trying to compete directly on price.
This is a direct test of the moat, and it highlights the barrier perfectly. FMX, even with serious backing, faces the immense challenge of overcoming that network effect. They lack the necessary decade-spanning institutional trust, the regulatory acceptance, and most crucially, the sheer clearing integrity of CME's clearinghouse.
So competing on price is a losing game from the start.
It's suicidal, really. CME, with its 75% plus margin, can afford to cut its fee per contract dramatically to repel a competitor in its core product without immediately suffering a financial collapse. The new entrant can't do that. They're operating near cost just to try and attract a tiny fraction of the liquidity. It's a classic example of an incumbent with massive operating leverage using that leverage to maintain market share against a cash-burning startup.
So the takeaway here is that the competitive fortress is validated not by the lack of competitors, but by the consistent failure of those competitors to erode CME's core market share and pricing power in its benchmark products.
That's it exactly.
It's clear that the business model is outstanding, but now we need to transition to the people running the show and how they manage this stream of wretched excess cash flow. What happens to all that money? Okay, so we've established that for a utility-like business, management's role isn't really about disruption. It's about preservation and rational capital allocation. Let's assess the leadership.
Right. And Terrence Duffy, the CEO, he really embodies the long-term focus required here. He's been CEO since 2016 and the chairman since way back in 2002. His tenure is one of continuity and strategic preservation of that market utility status.
He's been around for all the big moves.
He has. His mandate has always been clear: maintain operational integrity and scale, rather than chase risky growth. And we see this in the massive strategic moves that built the modern CME. The consolidation of the Chicago Board of Trade, the CBOT, the NOMX acquisition, and that far-sighted long-term Google Cloud partnership. These aren't quarterly moves. They were decade-spanning projects designed to reinforce the moat and enhance efficiency.
We often look at management incentives. For a CEO with a compensation package in the tens of millions, how are shareholders assured that his priorities align with long-term owners?
Well, the compensation structure, it really passes the alignment test. Over 90% of the CEO's total pay is tied directly to long-term performance. So stock grants and options that are linked to metrics like EPS growth and sustained return on invested capital.
So his payday depends on the stock doing well over time.
Precisely. And furthermore, while the total percentage of insider ownership today might seem small relative to the massive market cap, the corporate culture is steeped in the history of the exchange system, where executives often transition from being members or owners of the former separate exchanges. It fosters this inherent owner-oriented mindset that's focused on stability and the long-term value of the franchise rather than just short-term financial engineering.
That focus on longevity and preservation of the utility status is so key. But let's look at the defining feature for investors, the capital allocation track record. What do they do with all that free cash flow?
Their capital allocation strategy is it's textbook rational and shareholder-friendly. They adhere strictly to a policy of prudent reinvestment, mostly into technology like the Google Cloud migration and organic product innovation like developing the microfutures and new index products. They are not out there chasing large, value-destroying M&A deals.
And the dividend strategy really speaks volumes about the health of the business.
It's the most powerful signal they send. They combine a reliable, regular quarterly dividend with an immense annual special dividend.
Which isn't common.
It's not common at all, and communicates to the market that the business is so capital light and generates so much cash that they simply cannot find enough high ROIC projects internally to deploy it. So what do? They return almost all excess free cash flow, often exceeding the entire year's net income, right back to shareholders every year.
It effectively acts as a variable share repurchase, but it's in the form of a dividend. It confirms they pass the rationality test. If the cash isn't needed to maintain the moat or to fund profitable growth, it goes back to the owners, period.
Exactly. This combination of structural profitability and capital return discipline is what transforms CME from merely a good business into a wonderful business in the eyes of long-term investors.
Now, let's solidify that qualitative assessment with the hard metrics. We've mentioned the high margins, but let's look at the fortress-like consistency.
The consistency is the competitive differentiator. Maintaining pre-tax profit margins between 67 and 76.5% over a 4-year period, spanning different economic cycles and volatility levels, shows that their pricing power is structural and, it's not cyclical. While volume can dip, their operating cost structure is so lean that the margin holds up incredibly well.
The ultimate test of competitive advantage, however, always remains the return on invested capital, the ROIC. What is the health of their ROIC?
The analysis shows a very robust ROIC of approximately 12.3% recently. Now, for an established utility-like company in a mature industry, consistently earning double-digit returns on capital confirms they are generating significant economic value. They are earning substantially more than their estimated cost of capital, which provides absolute confirmation of the structural competitive advantage we talked about in Pillar 1.
Let's delve a little deeper into the free cash flow mechanics, because 12.3% ROIC, while strong, it doesn't quite capture the full picture of the cash generation. You mentioned FCF conversion is well over 100%. What does that mean in practical terms for the listener?
It's crucial. When FCF conversion is over 100%, it means the company's net income significantly understates its actual cash flow generation. And the reason why is because the non-cash expenses, primarily depreciation and amortization, are very high relative to the tiny amount of actual cash capital expenditure they need.
Can you give us an analogy?
Sure. Think of a high-tech software company that invested billions 15 years ago to build its core platform. That initial investment is being depreciated on the books, which reduces net income. But today, they only spend a tiny fraction of that depreciation expense on actual cash capex to maintain the platform. That huge gap between depreciation and capex shows up as massive free cash flow. CME is running like a high-margin software firm that's built on regulatory bedrock. The earnings quality is just exceptional.
That is a clear confirmation of the asset-light nature. Finally, how does the balance sheet stack up? Is this fortress built on solid rock, or is there some hidden leverage we should worry about?
It's solid rock. The balance sheet is extraordinarily prudent. Total debt is manageable at around $3.4 billion. More importantly, when you look at the debt relative to their operational earning power, the net debt to EBITDA ratio, it sits comfortably under 1.0x at roughly 0.8x.
Which is very low for this industry.
In a financial services environment, a leverage ratio this low signals immense financial flexibility. They aren't beholden to creditors, they can withstand severe short-term market turbulence, and they have the dry powder to execute strategic technology upgrades or even opportunistic acquisitions without straining the balance sheet. It is a financial fortress in the truest sense.
So we have an undeniable case for a high-quality, wonderful business. If we stopped here, the recommendation would be universal buy. But investing is about the future, and it's about the price paid. That brings us to Pillar 3, valuation, risks, and catalysts.
This is where the surgical analysis truly begins. The quality of the business is a known quantity. The price is the debate.
And the market has already baked in this quality, right? It's reflected in a current PE ratio around 27.2x. This is a high premium. What are the three core arguments the market uses to rationalize this multiple?
First is the perceived certainty. Investors pay a premium for stability, predictability, and a near monopoly structure. The risk of permanent capital loss here is extremely low. Second is the capital structure advantage. The market rewards asset-like businesses with high FCF conversion and that track record of massive capital return via those regular and special dividends. And third is the quasi-utility status. Earnings are correlated with macro activity and volatility, but the structural fee collection gives it a utility-like stability that high-growth tech stocks just don't possess.
So if 27x is the floor, where does an intelligent investor find a margin of safety? We can't expect this stock to suddenly trade at 10x earnings.
Correct. The margin of safety is not found in an undervalued price based on normalized earnings. It must be found in temporary reversible distress. An investor looking for a high margin of safety must wait for one of two scenarios.
The first being an external shock, the indiscriminate panic.
Right. A market-wide panic like the initial shocks of the 2008 financial crisis or the COVID market dip, where asset sales are indiscriminate and quality is temporarily divorced from price.
And the second?
The second is the company-specific temporary failure. This is often more realistic. We'd be looking for a sustained, prolonged period of extremely low volatility, of financial doldrums, where average daily volume drops significantly, causing a material dip in revenue and earnings.
Or some kind of accident.
Or a major but fixable internal event. Something like a technical outage that causes a trading halt, or a sizable temporary regulatory fine that causes a short-term crisis of confidence, but without permanently harming the clearinghouse's integrity. Buying into that fear is how you secure a margin of safety.
The lesson here is paramount. While the risk of permanent capital loss in CME is low, the risk of low future returns is high if we pay too much initially.
That is the ultimate hurdle. We have to do the math. If you pay 27 times earnings for a business whose long-term underlying volume growth is likely in the high single digits, say 7 or 8% annually, your total returns are fundamentally capped near that rate. For investors looking for higher returns, you would need the PE multiple to expand even further, which is highly unlikely for a mature premium multiple stock. The law of large numbers and high starting valuations works against us.
So the disciplined investor has to wait for an entry point that offers a meaningful earnings yield, maybe suggesting a PE target closer to 15 by 20x on today's earnings. This necessitates extreme patience.
Absolutely. The quality is not debatable. The price is. Now let's explore the growth drivers that could potentially accelerate that earnings growth and maybe justify a higher multiple.
The primary engine, as we discussed, is that increasing global adoption and complexity of risk management, which is a big secular tailwind.
But drilling down, the current specific tailwind is the transition to SOFR futures volume driven by global interest rate uncertainty and the shift away from LIBOR. CME is the undisputed leader in defining this new benchmark. Second, the rising tide of retail engagement through microfutures continues to be a positive volume driver. And third, the institutionalization of regulated crypto derivatives positions CME to capture high margin exposure to that asset class without taking on the same volatility and credit risk as pure crypto exchanges.
Okay, now let's invert this to the true existential risks, the things that could permanently break the fortress and justify a collapse in that 27x multiple. What are the two biggest bear case arguments?
The first, the low probability, high impact risk, is a clearinghouse failure. If CME, as the central counterparty, were to experience a catastrophic operational failure, a massive operational error, a default that exceeded their margin reserves, or a systemic IT collapse that permanently destroyed the trust of market participants, the network effect vanishes overnight.
Trust is everything.
Trust is the air the moat breathes. If participants can't rely on the trade being guaranteed, they simply stop using the platform.
And the second risk is the threat of intervention from above.
That is the regulatory disintermediation risk. Because CME deals in benchmark products like U.S. Treasury futures that are essential infrastructure for global monetary stability, regulators theoretically have immense power to intervene. A new mandate could force market participants away from CME, or, critically, a government-backed or regulatory-sanctioned competitor could be introduced in core products.
And that risk grows with their profitability.
That risk gains power precisely because of those 75% profit margins. That high profit margin is viewed by the major financial institutions, who are CME's largest customers, as an excessive toll. They have the collective power and political capital to lobby regulators to force greater competition or lower fees. This is the existential threat we call the quiet death, which we will elaborate on soon.
Before we get to the quiet death, let's look at the positive upside surprises, the catalysts. What could accelerate volume beyond the current expectations?
The most immediate catalyst is always sustained macro volatility. A prolonged period of high inflation, frequent central bank rate changes, as we've seen recently, or escalating geopolitical stress consistently drive the need for hedging activity. This translates directly to higher ADV and, due to the immense operating leverage, sharply higher revenue and FCF. The engine is already built. It just needs more traffic.
And what about structural catalysts?
The most important one right now is the potential for new regulations regarding the clearing of U.S. Treasury securities. If regulators mandate that more of the cash Treasury market must pass through a regulated clearing facility, like the one CME operates via BrokerTec Chicago CME, could significantly expand its market share in a vast, stable market. Successful execution of their BrokerTec launch is a major catalyst to watch.
This brings us back to the market consensus versus the contrarian view. The consensus sees CME as a premium utility with growth tied to general economic complexity. What does the second level of thinking suggest we might be missing?
The second level thinking acknowledges the moat but challenges the inevitability of its pricing power. The market consensus may significantly underestimate the permanent regulatory risk precisely because of the extraordinary profitability. The sheer scale of the profits acts as a lightning rod for intervention. If the toll becomes too burdensome for the largest financial institutions, the regulatory pressure to break the network effect increases substantially.
But on the flip side, what might the market be underestimating about the upside?
They might be underestimating the extreme operational leverage and the FCF acceleration driven by the technological investments. The Google Cloud partnership and the move to micro-futures were capital expenditures of the past. If ADV accelerates, the drop through to free cash flow, already at over 100% conversion, will be exponential. The market might only be modeling high single-digit revenue growth when FCF growth could potentially spike into the mid-teens during periods of high volatility.
So that's the critical tension, regulatory pressure on pricing power versus the extreme operational leverage on volume.
That's the whole game right there.
Let's synthesize everything now, moving from the positive attributes to the major risks, and then we will finalize with the ultimate red team challenge.
The bull case is robust, anchored by 4 points. First, the impregnable liquidity network, Moat, the absolute trust in the clearinghouse and the necessary liquidity in benchmark contracts. Second, exceptional financial quality, marked by those 75% plus profit margins, outstanding ROIC, and superb FCF conversion. Third, disciplined management and a highly shareholder-friendly capital return policy, including that massive special dividend. And fourth, the secular tailwinds from increasing global financial complexity and expansion into new areas like regulated crypto.
Now, the bear case. The arguments against owning CME at today's premium price.
The bear case hinges on volume cyclicality, the dependency on unpredictable market volatility, which can lead to periods of earnings stagnation. Crucially, the high valuation caps future returns unless growth accelerates or the market panics. Third, the regulatory risk targeting the high clearing fees. And finally, the very real, albeit low probability, risk of a systemic technical failure destroying market trust.
This brings us to the ultimate stress test for any high-quality business. The red team challenge. Inverting the bull case and imagining the worst long-term scenario, the quiet death. What does it look like, and how could that 75% margin profile fundamentally be destroyed?
The quiet death is the most compelling threat to CME's long-term valuation. It is the risk of permanent pricing power erosion resulting from the combined force of regulation and technology.
And it all comes back to that profit margin.
It does. The fundamental problem is that the 75% plus profit margin is not a feature. It's an invitation. It acts as a massive magnet for competition, primarily from CME's own largest customers, the major financial institutions. They pay billions in tolls annually, and they are deeply incentivized to reduce that cost.
So the financial institutions themselves organize to challenge the incumbent? How would that work in practice, given the regulatory barrier?
They would need to leverage new technology and regulatory compliance simultaneously. Imagine if a consortium of Tier 1 banks and brokerages successfully built a new platform using distributed ledger technology, DLT, or blockchain, capable of matching trades and settling them with extreme efficiency and transparency. And they submitted this platform for regulatory approval as a clearing mechanism.
So they build a competitor from the ground up.
And if that consortium successfully launches a credible, regulatory-sanctioned benchmark contract, perhaps a new interest rate contract specifically designed to be low-cost and deemed safe enough by regulators, it would bypass CME's established network.
And since they are the customers, they have the volume and the political weight to force adoption.
Exactly. Even if this new exchange only captured 20% of the volume, CME would be forced to respond. They would have to defend their territory not just with liquidity, but with price.
A price war.
A price war. If CME is forced to cut its fee per contract, dramatically, say, lowering that 75% margin structure down to 40 or 50% just to maintain liquidity dominance, the consequences for earnings are devastating. High volume growth, which we rely on to justify the 27x multiple, would be entirely offset by the declining rate per contract. The result is flat, or declining absolute earnings over a 5 to 10-year period. This would retroactively validate the initial high valuation as fundamentally flawed, transforming what appeared to be an unassailable infrastructure play into a low-growth, high-multiple value trap. It's a slow erosion of economic value, the quiet death.
That is the ultimate fear when investing in a capital-light monopoly. That the competition is not a better product, but regulatory intervention designed to redistribute the monopolistic profits back to the powerful customers. That is the tension we have to constantly monitor.
Absolutely. The question for you, the investor, is assessing the probability of that event. Does the clearinghouse's integrity outweigh the combined power of the banks and the regulators who want lower fees? Historically, the answer has been yes, but the regulatory environment is shifting, particularly around core Treasury market infrastructure.
So after this deep dive, the final synthesis remains clear. CME Group is undeniably a wonderful business. It is a financial fortress with a near unassailable liquidity moat run by disciplined management and generates cash flow that few companies on earth can rival.
It is the definition of a stock you want to own forever, provided you buy it at a price that respects the reality of its future growth prospects and the material risks that accompany its extraordinary pricing power. The analysis is about the price paid, not the quality of the asset.
Which brings us to our final provocative thought for you to explore as you continue your research. The ultimate tension at the heart of CME's valuation is this. Which force is more powerful, CME's existing embedded, decades-spanning liquidity network effect and clearinghouse trust, or the combined financial and political weight of major financial institutions and regulators seeking to permanently reduce the toll they are obligated to pay?
We encourage you to specifically research the recent regulatory mandates and discussions surrounding U.S. Treasury clearing and the movements by new consortiums to challenge established benchmarks. That's where the real risk and the potential catalyst lies.
Thank you for joining us on this deep dive into CME Group. If you appreciated this level of detail and comprehensive analysis, please like and subscribe to ensure you don't miss our next deep dive.
We'll see you next time.